So here we have it, part 3, selling 0 DTE put spreads. He doesn't give it away, but we're looking at double dipping.
Double dipping. All right, let's hit it.
Okay, key advantages of managing winners early with longer dated trades is the ability to redeploy capital.
Yeah, the 0 DTE options market, the underlying such as this liquid, active, from open to close.
And so we'd say this often with our longer term trades. We'll say, oh, well, we only made 10 or 20%, but we'll take this off and put the money into something else, or take this off and maybe get back in at a later date. And so with the 0 DTE, if you're taking a smaller percentage, can you get back in?
Do you redeploy the capital? Does it make sense? So that's the question we're going to answer today, and they're very loud today. Okay, let's go to next one.
All right, the study using 2.5 years of data in the 0 DTE SPX.
We've done this over and over. It's always 2.5 years of data, and it's every 10 minutes because it's just coming in blocks, so it's okay.
Yeah.
It's a good data.
Yeah. Okay. Began each day selling a $10 wide put spread at 9 a.m.
Done.
At the money, short strike. On those days when this trade reached 10%, just 10% of max profit, closed it, and then sold a fresh spread with adjusted strikes. That's what the study's looking at.
Yes, and then and analyze the performance of these second trades only. So we're not even going to talk about the first. It's the second trades only when we're going through this.
Right.
And we repeated the analysis looking for 20% of max profit instead of 10. So the first ones were closed either 20 or 10. So we're only looking at the second trades of the day.
And then they also looked at $20 wide put spreads with short strikes at 25 delta. So we're looking at $10 wide at the 50 delta, $20 wide at the 25 delta, and the results are only the second trades of the day.
Correct.
All right. Here we have the $10 wide at the money. Now these are the second trades. Win rate, high.
The win rate is very high across the board, I would say, right? Mm-hmm. But what they did is they broke it out by time, which I like. So you've got it at before 10, 10 and 11, 11 and noon, afternoon. All the win rates are very high. You can see that all these are pretty good. My eye line, though, Jenny, goes to your sample size. Look how many more are in the placed before 10 a.m.
Meaning that sample size, let's see, sample size, all trades, placed before 10 a.m., 415.
Yeah, 415 were off at 10% and then on before 10 a.m.
But think about this. If
10% is so easy to get. 10% is so easy to get in an SPX trade.
Right.
I did it today at 9 o'clock. I collected $380. If I wanted 10%, it would be $38.
But you know what else catches my eye is later you've got that small sample size, which to me means if yours doesn't come off for a win by 10, most of the time it's not your first trade. If your first trade doesn't come off for a win by 10, most of the time it's not coming off for a win after that.
That's why we said close it at noon. That's what we're springboarding off here.
So maybe, honestly, after looking at these results, if it's not closed at noon, it's closed at 10.
But my I don't know if it's before 10. Maybe it's
you see between 10 and 11, the sample size is so small.
Get out before 11. You could put it on at 10 o'clock. So when I look at this, my takeaway, and like I said, these are menus, but my takeaway is if I'm asleep, which is never going to happen, in the morning, and I wake up at 9:37, and I was like, I could put this on because I could look at this as a standalone. There's so many sample sizes. That's my takeaway from this.
Right. I agree. My takeaway isn't necessarily, I've got to put on one, take it off for 10% and put on the other. It's, okay, if I didn't get it on 8:30 and I was doing something, I can still put it on a little later and there's still a nice success rate. And so what is, and there are more slides, we're going to go through these, but they're all profitable and they're all high percentages. Yes, that's true. They all are. Yeah. And this is only looking at the second trade, assuming your first trade closed at 10%. 10%. Okay. Here we have the $10 wide at the money short closed at 20%. And this is just the second trade. And once again, the only one that is not profitable, this is different. So I think that if you're putting on a second one, 10%. The farther you go, you got to lower your bar, right? Because you got to put, there is a negative here. Right. There's one negative, and it's between 11 and noon. Right. But there's only 34 sample size, which isn't a lot. Right. So you do get you've got the much higher sample size early on. Yeah. I think, meaning, I like these trades earlier. We've seen this. Our studies have shown these trades, 9 o'clock is the sweet spot for putting the initial trade. And then if you get out of that one and you want to put it on again, I wouldn't do it too late. I wouldn't do it too late. No, I wouldn't either. All right, let's keep going forward. All right, here, now we're looking at $20 wide at the 25 delta. So you're starting your short put at the 25 delta, making a $20 wide put spread. And this is taking 10% out of it. So taking 10%, you can see here, the 10% seems to be the key. There's no losses. But once
again, your sample size is so much bigger. That's what I'm looking at. Your sample size is so much bigger with a high percentage rate before 10 a.m.
No.
I mean, it really drops off between 10 and 11.
It really does.
Really, in all the examples, it drops off.
So the win rate is very high, right? 97, 98. And the previous slides with the 50 delta, the win rate's slightly lower. I'm just curious, if you start with one trade, could you switch to another? Let's say I start with 30 delta, $10 I put spread, and if that comes off quickly, then switch to another type of trade that's coming in as my second trade.
Well, I mean, you could layer these studies on top of each other and look at what you want to do. Once again, I think these are all kind of good results because you're looking for very short pops. With these, we're not saying, SPX needs to be up on the day. We don't care if it's up or down on the day.
You just need a quick pop to get out.
You just need a quick pop. And they're kind of building, because the one study a long time ago, and this has nothing to do with this, saying that at 9 o'clock there's more up moves than there are down moves. And that's what's saying. Before 10 a.m. they're already off, and you have 488 occurrences.
Yeah. So, and then now we've got one more, I think, $20 wide put spreads, $25 short strike, and taking 20%. You can see your average P&L goes up, and the win rate is still high.
They're still high, but it's still the same. To me, I see the same thing in all these. It's got to be before 10 a.m. because your number of occurrences really drops drastically.
Right. So I think takeaways, well, and we can see what Jacob's takeaways are. Our takeaways are, if you miss it at 9 o'clock, don't feel like you completely missed it. You can still put it on a little later, and that would be the initial trade. If you want to put on the first trade and take a small win, and then the second trade and take a small win, fine. I think I still prefer one trade for a bigger percent. I put my trades on this morning and tried to take 35% out of them.
Yeah.
And were you trying to take 35 or 50%?
50% out of the ones that were at the monies, and 35% of the ones that were farther out of the monies.
So, but as far as commissions go, a put spread, it's just 2 legs. So it's not like you're dealing with an iron condor where it's 4 legs and you've got 4 legs of commission. This is just 2 legs.
It's just 2 legs. Let's see his takeaways. Okay, being directionally correct is an advantage, and there have been very few poor ways to sell SPX puts recently, but that shouldn't stop us from looking at the best. I like that. All
right, when winning credit put spreads came off before 11, starting another trade was an effective way to increase daily profits. But again, this study is lowering your profit target on the initial trade.
And your second trade.
Yeah.
On both, because 10% or 20% is low for these, as we've established in last week's.
I think I still prefer just the one trade with the higher percentage, but everyone could choose what they want.
And then every trades placed later in the day, however, were less successful as there was very little credit left to sell, especially out of the monies.
Right.
Yeah, especially the out of the monies, the 20 deltas.
Right. Every day is a new set of opportunities for zero DTE traders, and when those opportunities pay off, especially quickly, you might even get more than one winner in a morning. Now, I have no problem putting one on, taking a bigger credit out of it, and then if the market moves back down, putting it on again.
And, we've got people like Blue Wackadoo and Jack Tucker, they layer into them.
Yes.
So that's not necessarily getting it for a profit. It's just your strikes are on.
Right, layering into them, starting with a smaller tranche, then adding another as the market's moving.
Yeah,
let's say
and I did that this morning. That's what I was trying this morning.
Okay.
Yeah.
Okay.